So we have about 30 minutes for questions, and before I leave it to the audience to ask questions, I want to pick up on something that Thomas said in his introduction, because we got three really good presentations on the various negative aspects of real estate prices, from target rules and more broader tools. But Thomas had a fascinating plot in his introductory remarks, which was the positive correlation between happiness and high real estate prices. So therefore, one might say this is a targeting real estate prices, but also be targeting happiness. Now, can I ask the three panelists to say something positive about high prices? They have nothing to say.
Well, what I can say is that I've been observing with great interest the public discussion about house prices in Paris. Not because I have nothing in Paris. I mean, the only thing I do in Paris is I go to a hotel if I'm in Paris. But it's interesting to see how much in these 2 years the concern of the public opinion there was that residential prices had been, in fact, descending, and that has been a drop of prices. And it was interesting to see how much the press and the political sector was every time showing a sign of joy and satisfactions as there was a movement of prices to recovery and to increase. And in this time we have been looking very much in particular at commercial real estate in Paris and in France, where there might be signs of excess. And by the way, the French authorities have been running a stress test exactly on commercial real estate these days. And simply to observe the fact that you may have completely different views and narratives is by itself interesting. And this leads me to the point that one of the issues on which we will have to reflect is indeed the narrative. How do you present this type of things? Probably what you have to, I mean, there are 2 ways of doing it. One is to be super technical, and the second is try to explain what are the broad risks. And the broad risks at the very end are the fact that almost every financial crisis has its origin in real estate problems. There are very few which are not interconnected with real estate problems. And at the very end, we are in a situation where what is at stake in terms of the capacity of the financial sector to support growth in the long term is so important that, in my view, macroprudential authorities can and have a legitimacy to speak to the public opinion in open terms. From this point of view, I am much less pessimistic than you have been in your introduction. I don't think that people are fundamentally unable to understand macroprudential policy issues. I think that there has been a full generation now whose future has been really put at risk from the financial crisis. I think, of course, there is the tendency of people to forget, but there is also the capacity of people to remember.
Thank you very much. Torbjørn, you have anything to say, something positive about high prices?
Well, you can say something positive about the moderate wine consumption, but then there's a risk of the hangover. And I think also the correlation that Thomas pointed out is very interesting. But one must also reflect that it's also driven by a happiness by low prices, and from some of low prices in the sample has come about from financial crisis with huge drops in asset prices, which you can put it the other way around. Well, we should actually do our best to try to avoid such shocks. But high residential prices, not necessarily as a high level, it's an effect of a high income level, a high income growth, and that's sort of what drives this correlation. But I will also agree with Francesco, and it's quite the debate in Norway has. In the years that have passed, is it not very difficult to get acceptance for the tightening of the macroprudential measures. People see the risks. People remember the 80s and also the financial crisis, while it didn't hit Norway as severely, and see the problems of younger persons not getting into the housing market. So I'm also on the positive side that Francesco put.
Yeah, just to complement what others have already said. Yes, if you own a house and house prices go up, you're happy. If you don't own a house yet and house prices go up, you may not be very happy. So that is actually another point. Another rationale for policy action, if you want, is affordability for first-time buyers, for people who want to buy a place. And I think that this affordability issue is actually in the minds of the public a lot when they're thinking about house prices. Wherever I travel, I've been to Beijing recently, Auckland. People are talking about house prices all the time. And it's because of that. It's because people can't buy a house or a house of their choice at the prices that they see out there. And I think that's a legitimate issue to talk about for policymakers, because it affects things we ultimately care about, like equality of wealth distribution and so forth and so forth. But I think also there is a risk that this creates sort of greater demands on macroprudential policymakers. I think again, my presentation, I think I was quite clear in setting out what are the objectives of macroprudential policy. I think you can overburden macroprudential policy if you mix in all of these sort of social objectives as well. And so I think those social objectives may be legitimate, but they are for the government and elected officials to address. Macroprudential policy can do its part by increasing resilience and by containing feedback loops, but that's probably all it can really do.
Okay, thank you very much. Now let's open it up to the floor. So anyone who would like to? Dirk, you have the first hand up, and then we have one behind you right afterwards, and a third in the back. So I'll take three then. Those three. Then.
Dirk Schoenmaker from Rotterdam School of Management. I think we had very good introductions. And I wanted to ask on Norway, there you see the prices coming down recently. And what is the main reason prices have come down in Oslo?
Okay. Let's take three questions. So right behind you.
Sampo Alhonso from the ESRB Secretariat. Also a question for Norwegian presenter. You said in your conclusions that macroprudential measures are best suited to build resilience for banks and households. And looking at the chart, which was quite impressive since 1820 about the house prices, I think the question is quite natural that what might happen in the Nordic banking and household sector when we assume, let's say, that the same macroeconomic situation will happen again that what happened in Norway 1980s. So what will happen, for example, for the house prices go down 30-40% in the period of 1 or 2 years?
Okay, and we had the last question in the back there.
Thank you very much. My name is Doris Ritzberger from the Austrian Central Bank. I want to come back to your question, what is good in rising house prices, and it reminds me a little bit to defending the price stability aim and monetary policy nowadays, because as a central banker it's quite difficult to explain some people that we're looking for higher inflation. So I think there are some similarities. But let me ask a question. What I missed in all three presentations is something about the level of house prices. Because we are living in Europe where some cities are very close to each other. Some countries are still in a transition process, in a catching up process. And of course the price level, for instance, in Slovakia is much slower than the price level in Austria. And people are migrating, people are flexible. Some of them, in the meantime, are living in Vienna, working in Slovakia, and also the other way around. So I missed this argument completely, that house prices are catching up and have to catch up with all this flexibility in the labor market, what we have today already. Thank you.
Okay, so I think 2 for Norway and one general. Norway first.
Yeah, to the first question of the main reason why prices are not down in Oslo, but the price increase has stopped. It has been more or less zero growth, and then from a base effect, the 3-month growth and 12-month growth, it has come down. So there's not a price decrease. I think there are two. I mean, we don't really know this yet. I mean, there may be several reasons for it. So one structural is that net immigration has come down and has also slowed down during last year. So the population increase in Oslo is somewhat lower than before. There is also an increase in the number of new houses on the market, but we think, or one might at least speculate, that the new tighter regulations that tighten all over, but also a specific tightening for Oslo and in particular for secondary homes has had some effect. And that's sort of the anecdotal evidence so far that there has been not a complete shift in sort of this sentiment in market, that things have cooled down a little bit. I mean, you don't have to have a huge change in sentiment. It's just that, well, the number of bidders for an apartment has gone down from 3 to 2, and that may cause prices to stand still. So I think we're a little bit of a wait and see. We think that my speculation is that we're going for a more soft landing with more stable prices over the months to come, but we'll see. So in terms of the resilience, the effects of building resilience, what would happen if we observed a shock to the Norwegian economy like the 1980s with a drop in house price of 30-40%? Of course, the answer to that question would be sort of depend on what kind of shock it was that that resulted in such a drop. We did a sort of a stress test, macroeconomic stress test in our latest financial stability report, where we resembled a shock similar to what you indicated. What we then show that, well, most banks in Norway would be turn off the CCYB, and the banks were allowed to dig into some of their buffers. But that the banks would be sort of robust enough to stand such a shock. So I think the Norwegian economy and banks are now much more resilient to such a shock than they were in the 80s.
The last question?
Yeah, someone else can start on that.
Yeah, I mean, so what about the level or the equilibrium house price? I don't have all that much to say about it. I mean, I think there are ways of sort of estimating what is the fundamental value of house prices and what is the deviation of actual prices from that. You typically look at things like population growth, income, and so on. Perhaps, though, it's important to note that there are structural factors, and I think I talked to them a little bit in my presentation, that are not easy to model in such analysis. So, in any event, I think the key issue is whether or not the asset prices are creating a financial stability problem by leading to an increase in indebtedness of the local population. So even if you can explain the increase in asset prices, say by a strong increase in immigration, that doesn't mean that there's no problem from a financial stability point of view, because if that push up in that increase in prices pushes up credit, you do have a problem to worry about. So that's what I would say to that.
So maybe before going into this question, I have a super small question to you on Norway. It's just a curiosity. It's you have been speaking about the financial crisis which terminated in 1905 and brought a collapse of prices for 100 years. Your country was created in 1905, so I would be quite interested to know whether this had anything to do with the political dynamics which brought to the division between Sweden and Norway, because at the very end we should not underestimate how much these things create ripple effects in the history of countries. But this was really a completely personal curiosity. The issue of the regional aspects and interrelation exists clearly. For example, everybody who is landing to Bratislava knows that it's convenient to fly to Schwechat and take a taxi to be there. But there is, for example, also the case of Luxembourg, which has a problem being a very small economy, it's a very small country, it does not have space, and you have a lot of migration, cross-border movement, and so on. Having said that, the problem is that even if these things are completely rationally explaining what is happening, the problem is when this is combined with a situation of over-indebtment of households. Because at the very end, this is a vulnerability which cannot go underestimated.
Okay, so we have one question already, waiting for Norway, so maybe we could get two more from the floors. There's one there in the back. And we have a second. So now we are covered for the next two.
Richard Bowell, I work for an asset manager. I had a question to Erlend. I think you said that macroprudential policy shouldn't be overburdened with social objectives, which I think I interpret to mean that you're comfortable with policymakers doing things which will have a detrimental impact on variables that appear in the loss function of the social planner. Now, that may be right, but I'm wondering how comfortable you feel as a policymaker recommending that.
Okay, and then we have...
Thank you very much. Two simple questions. First one, if we think to target house prices, have you got any idea how much would be the desired rate of change in house prices? So this could be very helpful in order to understand in a more deeper way the complementarities with monetary policy. Okay. The second question relates to known unknowns and unknown unknowns. That's the first speaker put in place, put forward, very interesting. My question is how much of the unknown unknowns could come from the real estate sector, on which we should acknowledge that research has made important progress to understand the determinants and the source of imbalances, and how much, on the contrary, could come from other sectors on which we need to investigate much more in the next future. Thank you.
Okay, so I guess the first question came to me. So what we learned from the three panelists is that we are very actively preparing for the known knowns in real estate. So I suspect the next crisis would perhaps come elsewhere. There are strategies for doing so, and we can certainly look for unknown unknowns in the various parts. For example, people are looking at the increasingly growing data sets accumulated by the public authorities. You will find a lot of information there. We've been looking at, in my center, we've been looking at Nier, for example, with the OTC derivatives, and there are places, there are strategies you can employ. But we have, and then we have two questions for the panelists here.
I can try to answer the short answer to Francesco's question, and if I have to give the shortest possible answer, I think it would be no. But it's sort of an interesting hypothesis, but I'm not sort of a historian, and in my view it has not sort of been linked. I think there were sort of deeper or broader forces driving the process up to the peaceful independence from Sweden.
Yeah, so the question to me, I didn't fully understand, but I tried to talk to the issue of objectives and assignment of those two either. So I think the issue is what kind of objectives do you assign to essentially technocrats, and what types of objectives do you assign to elected officials? And there's another way of another question around that is, are you comfortable assigning an objective if the pursuit of that objective may have side effects for social objectives? And I think the answer to the second question I'm clear about, which is yes. So I think it's quite clear that, for instance, monetary policy in the pursuit of price stability has effects on people's lives and has effects on inequality and so on and so forth. And indeed, there's been some debate about this in Europe recently. But still, it makes very good sense for the objective to be assigned to an independent authority like the central bank because of the political economy problems that arise if you assign it to the Ministry of Finance. I think the logic is very similar for macroprudential policy. It makes a lot of sense for that to be somehow pursued independently from the political process, even if some of the tools that are being used have side effects on sort of social objectives, if you want. Because of these side effects, though, I think it's important, especially for macroprudential policy, to be conducted in the context of strong overall support at the political level and at the social level for the idea that financial stability is worth pursuing as an objective. So I think you need to have that kind of consensus as a society for macroprudential policy to be pursued effectively.
Okay, might have a chance for one or two questions. Thomas?
Thank you. So my question is for Norway again. To my knowledge, when taking action, you didn't specify any numerical targets. But nevertheless, we're all policymakers, macroprudential policymakers, we are learning by doing. And nevertheless, I would like to ask a question. What would you consider a success or failure of your actions? So, for example, by how much, and until then, indebtedness has to decline. Would you be concerned if house prices were to start increasing again? So I was a bit wondering about your ex-post assessment, how you're going to assess even though or maybe you specified in the end some targets or some indications what you want to achieve. It's more sort of practical question. Thank you.
Okay, I think we might have time for one more, or at least. Yes, one more in the back. That will be our last for this session.
Kristina Grigaite, Bank of Lithuania. Again, a question probably mainly directed to Norway, but maybe some other discussants will have ideas. I hear from the justification about high prices is that you also have high income, and we kind of tend to judge say that it's normal to have higher prices when we have higher income. But we also know that income is cyclical. So don't you think that justifying high real estate prices by income is kind of amplifying the fluctuations in the cycle? Thank you.
To Thomas' question, whether we had sort of set and sort of success or failure measures from for the macroprudential for the introduction of various macroprudential measures. No, we haven't. Well, what we will do is, when we do our sort of financial stability assessment in our financial stability report, and also the quarterly assessment for the CCYB, we do an assessment of the sort of the financial stability stance in a way, and that would sort of be a holistic view. But of course, we would worry if house prices continue to rise in this house price and debt continue to rise at the pace that we have seen, as we stated in our letter to the Ministry of Finance, that increased house prices and household debt are signals that financial imbalances are building up. If they continue to increase at the same pace, it would sort of indicate that they are building further up. But that would be sort of a holistic view on it. And to the second question on the relationship between income and house prices, of course, that was more in terms of the correlation. Because there is a correlation between income and house prices, and also to the former question. What we also find in Norway when you sort of looking at, is there a bubble in Norwegian house prices? Well, doing an economic analysis, we can sort of explain house prices, and development house prices may be perfectly explained by fundamentals, including income, interest rate, demographic changes. But our view of the risk is that, fundamentals may change fundamentally and fast. And then, if you have an indebted household sector, then you have a problem.
Francesco?
I want to answer to the question on the known unknowns. and the unknowns. I think the area on which we should focus is commercial real estate, for the element of volatility it brings in the financial sector, and because of the interconnections which exist at the international level.
Okay, now we have about 3 minutes left, so I was maybe I would ask the last question myself to see if anyone would take it up. In the United Kingdom, I can get a mortgage at a negative 2% rate. That is negative 2% real rate. That's the latest offer you get. So clearly the monetary policy of the United Kingdom has a strong impact on mortgage borrowing rates and therefore demand for mortgages, therefore real estate prices. None of you said anything about monetary policy of interest rates. Does anyone want to say something about not the macroprudential tools mitigating the consequences, but monetary policy encouraging the real estate bubble?
There is a report, the record on these from the SRB and also the ECB on the low level of interest rates and the macroprudential policy, on which we have been working for almost 1 year. So I should not give the impression that we have not been discussing on these things, because we have been discussing on this a lot. Having said that, I would say that the monetary policy stance may well create these problems, but may be right in its own. And from this point of view, it is a given. So we have to take monetary policy as a given, and we have to use actively macroprudential instruments to try to preempt the negative implications of monetary policy.
So you said something interesting. You take monetary policy as a given. Now, it's the same authority is doing macroprudential policy and monetary policy. And so you're saying macroprudential policy is essentially subservient to monetary policy, not decided on the same level.
Monetary policy has a target which is in the treaty of the European Union. And of course, it is overarching.
Okay, thank you very much. We now have half an hour for coffee.